Good afternoon, everyone. It's been a while since I recorded a video. Today I want to talk about the everything bubble and exactly what it means. I think sometimes United States citizens, we really don't see the big picture as to what is creeping up on us financially because it takes such a long time to start to manifest itself. Just like a common everyday person didn't see the 2008 crash coming, they're not going to see the next big recession slash even depression I believe that the United States will find itself in the next 1 to 3 years. But here is it all laid out in front of you. So there's some things I want to cover. We have the United States stock market, and again, this is specific to the United States right now. We have USA Treasury bonds, and of course corporate debt is kind of lumped into that as well. We have the dollar oil peg, so the correlation between oil and energy being bought and sold in dollars, and then all the rest of the currencies that are basically force pegged or had been force pegged to the dollar because they had to have dollar reserves on hand in order to purchase oil on the international market, because oil was priced only in dollars. We had home prices. Home prices, as you know, got so high right up to '08 that your everyday person was having a hard time actually buying a home. So they had to go to basically no questions asked, sign and go loans, get in that house and go. And that was all due to super cheap money leading up to that. Alan Greenspan began to lower rates dramatically, which fueled that home bubble. I believe that the bubble still didn't actually fully burst because Ben Bernanke pumped money into keeping the home prices elevated due to keeping cheap money down low, the borrowing costs. At the same time, what we have plaguing America is student debt. We have the next generation of students who have gone to school. Maybe they've gotten a bachelor's, a master's, maybe even a PhD, and they're still either without a job or they're underemployed or they're working two part-time jobs. So the jobs aren't there to support all the debt that they got into to get that paper degree. Then for the working middle class, you just have a high amount of just regular consumer debt. So that is credit card debt, personal loan debt, anything to just kind of make the ends meet every month. And then you have auto loans and auto debt that's also intertwined in there. And underneath it all, in the very tiny portion of it, we have precious metals or real money. So how do we break this all down, and what clues do we have based on what the Federal Reserve is broadcasting to us currently? So as you might know if you follow, the Federal Reserve has backed away from raising interest rates at all for the rest of this year, and they're kind of dangling a potential quarter basis rate hike in 2020, which I don't believe will actually happen. What we're looking for now is we're looking for the Fed to not only start talking about backing away from rate hikes, but out of the blue, all of a sudden, somewhere this year, do a quarter rate cut. So go back into a more aggressive quantitative easing. This might start or happen as weak economic data rolls in, whether that's non-farm payroll data or other pieces of data. But I do believe that they will back away from that. So what's happening? Well, the stock market is a good it's not a good indicator. You always want to look at the U.S. Treasury debt, debt markets, bond rates, cost of money. That's really what you want to look at to get a good idea of what's happening underneath the economy, the real economy. Stock market is nothing more than illusion. But what is interesting about the stock market is it tends to front run trades and front run policy, monetary policy. So the Federal Reserve, having backed away from interest rate hikes for a while, the stock market is actually kind of anticipating that the Fed will probably do a rate cut, and so you'll start to see the U.S. stock market go even higher and higher than its all-time highs. Now, some people call this a bull run sucker, it's kind of a sucker rally. Pull the last suckers into it before it all comes crashing down. And I've been on the fence on this, whether we're going to experience a meltdown or a melt up. And kind of from what I'm seeing and what my belief is, I think because of how dire the situation is, I think the Federal Reserve has found themselves in the same spot as Venezuela under different circumstances. Okay, so I do believe because we don't have a politician, even Trump, who will be honest with the American people and declare a real bankruptcy and tell everyone that's what's up, we're going to hide it through papering over everything or mass money printing. And so that will create what's called a melt-up effect. So I think we will continue to see the Dow stock market go higher and higher and higher, just like the Venezuela stock market did, 28, 30, 32,000 points. However, in doing so, the value of the dollar, the purchasing power, will begin to fall through the roof. So fall through the floor. So we're at 96. It'll crash through 90, crash through 85, crash through 80, right? So the actual buying power. So what that means is, as you maybe get paper gains in the stock market and you sell your stocks into dollars, that dollar will immediately begin to lose its purchasing power. So if you don't put that into the economy and get that onto something real, you're going to lose your purchasing power pretty rapidly over time, just like the people of Venezuela have found out. Then we have U.S. Treasury debt and funding government. Government is so big, and there's so many entitlement programs, and they're I call them socialist programs because that's exactly what they are, free lunch programs that we have to fund and support, because we're going to have a lot of angry people in the streets if they don't get their handouts that were promised to them. So the handshake between the central banks, Federal Reserve, and the U.S. government and politicians continues. So the U.S. keeps printing treasuries. Now the rest of the world has stepped away from buying a meaningful amount of U.S. Treasury to even support our spending habits. So behind the scenes, I can 100% guarantee you that the Federal Reserve is the only buyer of U.S. Treasury debt right now. And so that means it's a complete fictitious market. It's not real, it's one big illusion, and it will all fall down like a house of cards, and that's why they're so desperate to keep this going, because it's going to be pretty epic when it does go. So they're buying the U.S. Treasury debts. At the same time, we have Russia, China, and other countries backing away from the dollar. They're creating, systems to bypass settlement of trade, whether that's oil or other things, out of the dollar. Last time this happened over in the Middle East, it created a military conflict between us and Iraq and and other countries, Libya. We tend to murder government officials and or countries that dare step outside of the U.S. dollar oil trade, and the reason for that is it creates a artificial support for our U.S. dollar and allows the United States to export its debt in dollars instead of having to export real goods in a fair trade. Okay, so all this hoopla about China, being a currency manipulator and China screwing us over, blah blah blah. It's only the half truth. At the same time, China is still sending us real goods that we actually consume on a daily basis. I mean, everything's made in China if you just look on the products. And all we do is hand them our U.S. Treasury bonds or debt, an IOU, right? We don't really give the same amount of goods, produced goods or raw materials to them to offset what we consume from them. So in my opinion, China's getting the raw end of the deal on that. For quite some time, but I believe that's starting to shift away rapidly here. At the same time, home prices are still elevated higher than what people can afford, especially up and coming young families, young people having a very difficult time getting into a home because they're still too expensive. And again, they're going to get much more expensive if interest rates continue to go up, and that's why they are backing away, because we're starting to see home prices begin to fall in key areas, key indicator areas like East Coast, West Coast, certain areas, down south. So that was starting to happen. So the air was coming out of that bubble. And then let's talk about student debt. Who is backing student debt? Well, ever since the government got into that business, the public is. The United States, we're all on the hook for the $1 trillion student debt that's just lingering out there that can't be paid back, will never be paid back by any of these students. So we have that outstanding. So that's going to have to be monetized. Consumer debt. I mean, the last time I checked, I think the average American person and or family has between 500 and 1,000 bucks in their savings. That's it. That's all they have. Auto loan debt. I mean, you have these sign-in drives. You have 84-month terms. You have lease deals. Anything to keep the automobiles moving. Otherwise, I believe that whole market area would crash because people just can't even afford automobiles as they continue to increase in price. And the most unloved of them all is precious metals, gold and silver, or as I like to call it, real money. And gold and silver have just been hanging out, at their prices for quite some time. Gold about, 1,900, 1,300 range, and silver, between 15 and 16 bucks an ounce. And very unloved. People know very little bit about it. And what's happening is everyone is putting their trust into paper IOUs, digital prints on the screen, and they have nothing tangible, no real wealth or asset in hand. So when this all comes crashing down, see, the rich are going to be fine, the uber wealthy are going to be fine, because all that paper money they've attached to real stuff, property, farmland, businesses, all the cars they could ever want to drive, exotics, stuff that all the middle class could just dream about having. So they have everything in place, real hard assets that will keep their value. They've also offset and hedged their paper holdings with gold. And if you notice, banks are starting to really increase their gold buys. Russia has been buying gold like crazy. China as well, investing in mines and mine developments and just hoarding gold, because at the end of this whole game, a 100% fiat money-backed system always must return to a sound money system. Sometimes you can keep it going longer than 40, 50, 60 years, but at some point, within 100 years, it all comes crashing down and has to get reset back into real money. And that's where we're at now. We're reaching that point. Whether we have another 5 years left in us or not, that's to be debated, but we definitely don't have 10 years left in this. There's so many things that are going to keep getting tacked on that is going to crash and all of this. And again, it only takes one of these bubbles to really pop, and the rest of them go with it. So that's what it really means to be in the everything bubble. So prior to 2008, the only real bubble we had going on was the home mortgage bubble. But because of that, it's basically caused the Fed to have to pump money into a lot of different other quote-unquote asset classes. And so we're kind of in a pickle. And they don't want the fair value or market value to really be found on any of these asset classes, including the stock market. And so they're offloading the last bit they can onto the suckers, the retail buyer suckers, the pension funds, and all that. And then it's gonna kind of come crashing down, or what's called melt up. Again, I subscribe to the melt up rather than melt down. So I hope that explains where we're at and all the different moving parts that are involved. Not a good outlook for the United States, as this debt will not be paid back. It will simply be devalued. And so what you probably will see in the future is the reason why they bring it back to not necessarily a gold standard, but they repeg to a certain portion of gold, and they allow the price of gold to adjust much higher, is because it resets the debt numbers really low that they can just pay off with all those paper IOUs, and they say, here, we satisfied the debt, we're good to go. And that's how a national economy resets. I forgot to include cryptocurrency in here, because I'm on the fence of where cryptocurrencies come into play and all this, at least the ones as they currently stand, Bitcoin, Litecoin, Ethereum, etc. I believe that the next Ponzi scheme being conjured up by the banks, JP Morgan Chase and the rest, is that they are just going to create their own blockchain cryptocurrencies, and they'll be the only ones that people will be able to buy and sell in. So we'll see how that unfolds. But the solution again is to this is not more is definitely not more debt, not larger government, not more social programs, not socialized health care. That is the problem. It really comes down to savings and saving in stuff that really keeps your wealth. It comes down to production and producing something that other people want, including the rest of the world wants to buy, and getting rid of the overhead and regulation, the cost of doing business with us in this country that prohibits businesses from wanting to keep employment and production here, and keep be competitive with labor rates and wages. The whole reason a lot of this has happened is because other countries, other people are willing to work for a much less dollar per hour, and so you have this battle between low wages or making the decision low wages, high wages, and then automation. And so that's a decision a company has to make. Either they'll export jobs somewhere else where wages are low and they'll keep it in the human labor area, or if that option is no longer available to them, they will invest into they'll automate every part of the business that they can, and they'll let robots do it, because robots can work 24/7, whereas a human can't. So that's my take on it, the everything bubble. Hope you got a lot out of that. And yeah, I'll keep you posted. Thanks, bye.